And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. I'm your host, Lance Roberts. It's the pre-Friday Eve edition of the show. And of course, Michael Lebowitz joining this morning. We've got to pick up and talk a little bit about the Federal Reserve and what is actually yield curve control, right? This is not a new weight loss deal, right?
Is it brought to you by Playtex?
No. You remember back in the day, like, you know, back in the 60s and 70s, they used to have those machines with the belts you put around your waist.
Yeah.
And it like jiggle the fat off of you. Exactly. So every time I think about yield curve control, that's what I keep thinking about in my head. So
It could work.
It could work. So talk about jiggling around. Last night I went to bed and Dow futures were down about 400 points. This morning I wake up, Dow futures are up 100 points, and now we're back down about 50 points. So I'm talking about a market here that just cannot really figure out what it wants to do. And of course, this is just, you know, kind of part and parcel of where we've been. You know, we've talked about it the last few days that we've had a kind of a money flow sell signal on the S&P so far. Markets have really just kind of been gyrating sideways here for the last week or so. And again, just kind of going through this consolidation process currently. What'll be important though is two things to keep a watch on here is this consolidation continues to maintain the 200-day moving average. That'll be the first important thing, but we're very close to now turning the 50-day moving average back above the 200-day. So that's always a bullish signal for markets. If we can do that, that gives some more lift to the markets, at least psychologically speaking. It doesn't mean you can't have corrections. And if you go back to 2015, we saw exactly this same type of event back in 2015. We had a decline in late 2015, very sharp over concerns about tapering the QE programs and, of course, Brexit. The market rallied back into early 2016. The 50-day moving average crossed above the 200-day moving average for just a very brief moment. And then in February and March, we had another big decline over concerns about Brexit. And that was, you know, at that time, Janet Yellen was calling up the Bank of England and ECB to do more QE at that point. The markets then bottomed at a lower level than what was the original bottom back in 2015. So we could be watching, theoretically, there is a risk here. We're watching the same type of action. Market really kind of suckers everybody in. You get a 50-day cross above the 200-day that's called the golden cross, gets all the bulls kind of excited in the markets, and then we have to deal with earnings and the economy later on this year, and you get another leg down in the markets later this year. Now, I'm not saying that's the case. I'm just saying that there is precedent that just because you do get these kind of bullish signals doesn't necessarily mean it's all clear, and we're certainly back onto the track to just, you know, unlimited upsides in markets. Yes, there's a lot of QE going on in the markets, and certainly understand that, not discounting that. All I'm saying is there is precedent that when we start seeing real earnings, and of course the estimates for earnings have not been lowered enough yet. We're going to see those earnings estimates come down even more as we get closer to the kickoff of the second quarter earnings season. Third quarter, fourth quarter are continue to be very weak. Investors are now buying, as we talked about this yesterday a bit, investors are buying out 2 years in advance for earnings. So if you're paying today for earnings 2 years in the future, that means you're locking in no price gains for 2 years. So as I was saying, you know, there's while the bullish kind of backdrop is good at the moment, and markets are certainly participating, there's a lot of frenzy in the markets, there's a lot of, you know, speculation in the markets. You know, we've talked about Hertz and these other companies, you know, running up sharply. Just understand that there is risk here that once we start dealing with economic realities as well as what's happening with earning realities, that there is a potential for a second leg in the market due to a corrective process, just simply to kind of to realign valuations with economics. You know, speaking of economics, you know, we're talking about trying to reopen the economy, and there's a lot of this bet in the market has been on just reopening the economy. We've talked about this before. No second wave of the outbreak. We'll have a vaccine. Everybody's just going to get back to doing what they were going to do. But there's still a lot of concern. If you take a look at polls of people and what they're talking about doing, there's a lot of trepidation about getting back out into the economy and going out to restaurants, doing these things. People, and particularly people and families that have, inherent risk, right? People that have pre-existing conditions, these type of things. Maybe they're older. They're even more reticent about getting back out into the economy and doing things. So again, while we've had this initial surge off the bottom, and yes, we saw some good employment numbers over the last few days. We saw some good retail sales numbers earlier this week. The issue, though, is that those are initial pops. And again, it's kind of fun with math. If you go from 0 to 1, you have 100% gain. So you can see these very big initial pops when you have very suppressed numbers up front. The important thing will be, is there sustainability of that going forward? And again, you had a lot of people locked up. They go out, that initial kind of pent-up demand hits the markets, but it's now going to be sustainability. Can we continue to grow those retail sales every month? Can we get the economy back on track to where it was? And the issue of very depressed employment issues at this point, lower incomes, lower wages, those are all going to weigh on that. And then of course psychology is going to be a big part of this as well. So again, just keep in mind that while this has been a great rally, and look, we do have some very bullish signals for the markets currently. Our portfolios are allocated. As I said yesterday, we're a lot longer stocks than I would like to be right now, but we have to be because of the trend in the market. We've got to participate with the rally in the market. All I'm saying is that there is risk, and so it's important to make sure and balance the risk in your portfolio with the expectation, or at least potential possibility, you could have a decline in asset prices. And this is why we've been talking about things like the dollar, of course, has been actually bottoming here. We saw a big decline of the dollar, seeing it now turn up here a bit. We're back onto a money flow buy signal with the dollar. We could see some more support coming out of the dollar. That helps hedge a portfolio short term as well. Same thing with fixed income. We've been talking about fixed income here for a while, that treasury yields got very depressed, and of course we're now starting to see a pickup here, actually very extended, and we're now starting to see a pickup in yields starting to come down, and bonds play a good hedge in portfolios against risk. So if as you take on more risk in portfolios, we continue to back that risk expansion up on the equity side with a pickup on our hedges of both gold as well as the dollar and treasury bonds. And balancing that risk gives you a little bit more control over your portfolio, lowers volatility in the near term until you have a better picture and a better outlook of what markets are actually going to do. Okay, we're going to get into a lot more stuff today. Got to talk about the Fed. Really, the Fed's talked a lot here about the corporate bond market. What does that mean? And also talk a little bit about yield curve control. We'll come back with Michael Lebowitz here in just a moment, right here on The Real Investment Show. I'm your host, Lance Roberts. So don't go away.
He's down on his luck, it's tough. So tough.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
Good morning and welcome to the show at 6:17. I'm your host, Lance Roberts, the Real Investment Show. Michael Lebowitz, CFA, joining us this morning as well. Lots of stuff to talk about this week. The Federal Reserve out earlier this week, Jerome Powell. And of course, he's kind of the news du jour, right? He's like every week there's something from this guy. He was talking about earlier this week that they're now going to start shifting more, towards actually buying corporate bonds in the market. And, buying corporate debt directly, actually buying the individual bonds. And, of course, this implies a shift away from buying the ETFs that they were doing previously. But the question, though, is why are they even doing this at this point? Because, again, these investment-grade companies have had, and actually even non-investment-grade companies, have had actually no problem going to the market. I mean, we saw bond offerings from companies like Carnival Cruise Lines and Boeing and others go to market, raise billions of dollars through a debt issuance, and had no problem selling it to the market.
Yeah, I was actually last night just graphing double B. So double B are junk bonds, their yields, and their yields are pretty much at the lowest levels in history.
Right.
Or at least, modern history. So think about that. We're in the middle of a recession, maybe a depression. We're in a pandemic that, we're hoping there's a cure vaccine. We're recovering, right? But even in a recession, we're at the lowest yields possible. If you go back and look throughout history, any kind of economic disruption, and I'm not just talking about 2008, 2000 recessions, but even if you go and look at 2016, the yields go higher because these companies have significant risk of default. Not significant, but, greater than 5%, and at times, upwards of double-digit % chance of default. So investors that are only earning 4 or 5%, knowing the company has a 4, 5, 6% chance of going under, are clearly not pricing in a great environment, let alone the current environment.
Right.
And that's where it's very disturbing, because I use that word investors are not pricing in, but it's not all investors. It certainly is investors, but it's also the Fed. And the Fed is partially responsible for yields being so low.
Well, but again, if the purpose of doing all this, and basically injecting billions of dollars into the corporate bond market is just to ensure that the bond market is functioning properly, if you're to look at the bond market and look for signs of stress, right, where it's saying, there's a clear sign, the credit market really needs, some support. We need to make sure that the credit markets function properly. I can't find any relevant evidence of that. Again, yield spreads are at their lowest levels that we've seen. Triple B yields are very low. None of that data implies there's any stress within the bond market whatsoever. But yet the Federal Reserve is injecting billions into these markets to ensure there's plenty of liquidity. It seems very confusing, considering that you've got a negative outcome from doing this in terms of economic growth, down the road.
Right. There's a couple things too, right? They're in the secondary bond market. These bonds have been issued. The companies have borrowed the money. What does it matter? This is all about investors. This isn't about those companies. Now, you can say that because yields are so low and the market is working well, that companies can come to market. And that may be a fair statement, that it's making it easier for companies to borrow money. But if that should be your only intent, if you're the Fed, so that companies have the ability to borrow money. And if that's the case, why aren't you just lending directly to companies that can't borrow in the market, as opposed to basically bailing out bondholders?
Well, because we are doing that, right? With the Main Street lending program, we're loaning money directly to businesses that potentially aren't publicly traded, right? They don't have access to the debt market, they don't have access to the equity market. So we're doing that. And the payroll protection program, we gave money directly to businesses to keep people on payrolls. So they can certainly do that, right? They could certainly just say, look, if you go to market and you can't find a buyer for your bonds, we'll buy it. And just provide a facility that says we'll be the lender of last resort, not the lender of first resort, which is what they've become now.
Right. And lender of last resort means the lender with not the lowest interest rate, but a higher or highest interest rate.
Right.
There's also part of the Fed thing that's really disturbing. So they announced this. We knew this, a month ago, that they were going to buy corporate debt.
Right.
And when they announced it, they said they were going to buy both ETFs and they were going to buy individual bonds. So the question is, why did they just come out a few days ago and say they're buying individual corporate bonds? We know they've been buying ETFs. And we think it's operational. There's really no news here. But why operational? Why, so they are constrained by credit rating, by company, by how many employees are in the U.S. They're trying to give the money, buy bonds from companies that are domiciled in the U.S. and that meet certain maturity and credit rating. Well, it turns out that that's not so easy to do. You can't you have to look into each company and buy the bonds. So they thought it would be easier to buy the ETF. So I think that's why they threw the ETFs into their clause. But when you look at the ETFs, they're buying companies indirectly that are outside of their own limits, right? The biggest company in J&K and HYG is a French company. for one.
And just to clarify
Right,
that, J and K and HYG are the symbols for the junk bond ETFs that the Federal Reserve's been buying. Yeah, and the largest company is French. And so we're loaning money to French companies.
Right. Junk French companies,
Exactly.
not even like quality French companies, and other companies as well. Companies that don't meet the requirements that were set forth by the Fed on what they can and can't buy regarding credit rating and maturity. So they basically, by buying ETFs, are sidestepping the law. And now that they can buy individual corporate bonds, it allows them to stay within the law that they originally wrote.
Well, let's be clear about this. Why did the Fed make that announcement on Tuesday? Was simply because, or actually Monday, when they made that announcement about buying corporate bonds, is because on Thursday the market slid by almost 6%. On Thursday, on Friday we flopped around a bit, testing the 200-day moving average, very close to breaking that support level for markets. Monday the markets opened down almost 500 points, and we're threatening, a reversal in markets. And again, as soon as that happened, the Fed, very quickly came back into action to support this was all about supporting the stock market. The announcement had no difference to it. We already knew all this. There was nothing about that, but it was the headline that the algos were looking for to start rallying the markets. And of course, we rallied back that entire day.
Right. And it's the same thing with the vaccines, right? Mm-hmm. Every time the market's down a decent amount, we hear that vaccines are so close.
Right.
We're almost there. We have one. It's almost there. I mean, it's these constant stick saves by the Fed, by the administration, to make sure that markets keep going up. And what's concerning, Lance, is that the amount of down market that's tolerable anymore is low. Right. We had that bad day last Thursday. We were down, 4 or 5%.
Yep.
And that got everyone out. That got the Fed out, the president out. They are going to do everything in their power to ensure that what happened in March will not happen again.
Yeah, and unfortunately, though, that creates two problems, Jeremy Grantham out just last night talking about this same thing, is that we haven't allowed the market to go through a reversion process. We've got investors making really bad decisions now. We talked about this during the monologue. For investors to try to justify what they're paying for stocks now, they've got to use earnings 2 years into the future, which means basically you're locking yourself into no price gains for 2 years on a valuation basis. And what are you going to do 2 years from now when you get there? You've already paid for those earnings, right? You've already invested based on those earnings. You're going to have to use earnings 6 years out. I mean, we're creating bad behaviors in markets for investors. And obviously we've seen this with Robinhood, and we've talked about Dave Portnoy on the show, just, the kind of flamboyant guy, but, look, I mean, Hertz was trying to sell bankrupt stock to investors, and they were lining up to buy it, and the SEC came out yesterday and finally said, hey, well, hold on a second. We're going to review you selling worthless stock to investors. So at least there was a break,
Right.
Somebody put on
them too long.
Exactly. Somebody at least put on a break before this happened. But, we're creating that speculative excess, that speculative greed. And I thought we had seen, kind of the peak of the bull market, in January and February in terms of exuberance and these type of things. But the reality is we're seeing the melt up and the exuberance now, which is more typical of a late stage bull market than a bear market recovery.
Right. And quite honestly, it looks a lot more like 99 than 08 or even what we were seeing in January, right? You're seeing the junkiest of junky companies that are bankrupt.
Right.
Right. They don't even have a chance. They've already filed for bankruptcy.
They're already in the coffin.
They're bonds. Bondholders are first in line, and they're getting 5 to 10 cents on the dollar. As a shareholder, what makes you think you're getting any money?
Yeah.
Or anything near where these stocks are trading?
Well,
and that's what's trading so well right now. We saw that with the companies back in '99 that were never going to make a dime, trading at $100 a share, $150 a share.
Yeah, no, and it's interesting. The people that are chasing these bankrupt companies are the young investors who have never been through a bear market before. And it is interesting because if you go back and look at 1999, you go back and look at 2007. I'm writing an article for Monday, and I went and pulled E-Trade commercials from back then. And it's funny because you see the exact same behavior all over again in the group of individuals who weren't alive at that time, right? So, for guys that have been around for 20 or 30 years and you've seen these before, you're going, yep, seen this before. I know how this movie ends.
Right. It's gambling. It's not. It's gone beyond investing, beyond speculating to gambling.
Exactly. All right, quick break. We're going to come back. We're going to talk about yield curve control. What the heck is that? Don't go away. I'm your host, Lance Roberts. Michael Lebowitz, CFA, joining me this morning. Don't go away.
You can't sleep, you can't eat, just don't down. You're empty, your throat is tight, you can't breathe. Another kiss, we saw you there.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Welcome back to us more. 6:33. Michael Lebowitz, CFA, joining us this morning. Got an email from Daniel. He actually lives in the UK. Very nice email. Very early this morning. Actually got it and asked if I would ask you a question about gold and inflation. And of course, this is going to lead us into talking about interest rates as well as the biggest risk for the Fed, which is rising inflation and rising interest rates, which would force them into a box of being unable to do programs like they're doing now. The question though is that really when you kind of look across the spectrum, we kind of touched on this last segment. When you look across the spectrum of valuations and economics, it certainly doesn't augur well for investing in the stock market, which has a lot of people talking about buying more gold. Really kind of looking at this as an alternative investment. But gold plays well when there's a lot of fear in the market and there's real worries about inflation, which would augur for wanting to own gold and having that in your portfolio. But, with what the Fed's doing now, in terms of QE, we've removed the fear of the fear of loss out of the market. So we were talking about a second ago, the bandwidth for a correction has now been reduced to less than 5%. We saw that last week. So there's no fear in the market, and this is why we're seeing bankrupt companies trade and all these type of things. And at the same time, you've got a depressionary economy, which is deflationary, so you really don't have much inflation risk. But you and I have talked about before, when the economy does reopen, we're going to have this inflationary pickup, at least temporarily. So what's the Fed, have in their toolbox, so to speak, to deal with that?
So, and I wrote about this yesterday. They're talking about a tool called yield curve control, and essentially, let's go back in time. The Fed introduced QE in 2008, as did the Bank of England and the ECB. Japan had been doing it before that, but they introduced it in large-scale size in 2008. They repeated it, QE2, QE3, QE4 last September, October, and then they just blew the lid off QE this time. Not only in size, right? The amount they're doing is startling compared to 2008, but also what they're buying. They've increased the menu on what they can buy. So if you look at the Fed is clearly intent on telling us what interest rates should be across not just the Treasury curve, across the mortgage curve, the corporate curve. So when I say curve, I say what should a 10-year Treasury that's AA rated yield? What should a 30-year mortgage yield? What should a 5-year Treasury yield? Because if you want to manage the economy, the best way to do it is with interest rates, especially in our economy, which is driven by debt. And that's also true for most other countries. Mm-hmm. So we're an economy driven by debt. What's the best way to manage it? Change the price of debt, right? It's like anything else. How do you manage the sale of apples or wheat or cars? You manage the price. If Honda wanted to sell a bunch of cars, it would be $5,000 cars on the market right now. And if they didn't want to sell any, they'd cost $200,000. That's exactly what the Fed's doing. They are taking more and more control of the economy and determining that they know what's best and not the the millions and hundreds of millions of people that should be determining interest rates. So yield curve control allows them to roll out with basically permanent QE and in amounts and timing that suit their needs. So what they would say is, we're going to, and they may say it publicly, they may not, but they would say, we're going to say the 10-year Treasury will never get above 1%. And if it does, we will do QE as much as needed to keep it below 1%. So basically, that sends the market a strong signal that says, don't go above 1% because the Fed will buy it all day, and you're just going to lose money. And that's essentially what the Fed would do. So rates go to 1%, 101, 102, 103. The Fed will come in with a bazooka and buy all the 10 years from the market until they get that yield down. And it'll work that way for a while until the Fed gets the joke. The market gets the joke. Once the market gets the joke, they'll be like, we're not crossing that line. You just lose money when you cross 1%.
Right.
So the market will kind of stay pinned at 1% or lower. And
but that has a, yes, I can control interest rates by doing that, so I can keep interest rates at 1%. But that doesn't necessarily mean that I can control inflationary pressures in the market, right?
Oh, absolutely not.
And so there seems to be, while the intent may be there, it seems like this is something you could lose control of very quickly, economically speaking.
Right. The way to control inflation is actually with higher rates. So if the Fed really thought inflation was coming, they would want to raise rates, stop borrowing, slow down borrowing, which would, the more borrowing, the more inflation there is because it's just driving consumption, it's driving demand for goods, and the supply is relatively the same. So, really what they should be doing is, and I don't think they should be doing any of this, but if they need to be doing stuff, they should be targeting yields to manage inflation. So maybe that means we're going to make sure the 10-year is above 3%, above 3.5%, above 4%, but they're not. They're going to keep it pinned at some number. Let's just call it 1% for argument's sake. And inflation's going to tick up, and it's going to be problematic. And if you go back, America actually did this from 1942 to 1950. And if you look at and that was to fund World War II, to make sure that all the funding, the government just blew a huge deficit to fund the war. But what they wanted to make sure was that the borrowing costs were manageable. I believe they set the 10-year at 2.5%. During the war, from 42 to about 45, the rate of inflation was low because people weren't buying anything, right? Everything was going. No. Yeah. GM and Ford were making tanks. They weren't making cars.
Right. You couldn't buy cheese. You couldn't buy clothes. You couldn't buy anything.
Right.
Yeah.
Kind of sounds like COVID a little, right? It was hard to buy stuff. It was hard to buy stuff, right? You got your necessities, but we weren't out there buying cars. We weren't out there buying those special items, right? So then in 1945, 46, the economy really opened up again. There was all this pent up demand. We're rebuilding Europe. Just a global boom. Right, both in America and the world, and inflation went into the double digits, and at that same time, the Fed kept rates pinned. So they're just fueling inflation at that point, and they didn't take their foot off the pedal.
Right. That seems to be. Go ahead.
In 1945, 46, 47, that wasn't too big a problem because the amount of debt outstanding was still relatively low, despite all the new war debt. Right. Today, the amount of debt is crazy, and it's not just government debt, which is out of control, but it's corporate debt, municipality debt, and consumer debt, and global debt, right? So you can't have 12% inflation and 2% rates. That will literally destroy the markets, the economy, everything.
Well, that's what I was going to ask you, though, because what we've clearly seen, though, during all these QE programs we've had over the last decade is that interest rates have continued to fall to lower levels. Inflation continues to fall. Economic growth continues to remain weak. And, coming out of this, we've now got, and even, as I said, coming out of the COVID issue, we didn't reverse any of the debt. We actually have more corporate debt, more personal debt than we had before. And, so we haven't resolved any of those issues. And we can't have higher interest rates because as soon as interest rates go up, it kills the housing market. Auto sales plummet. Consumption slows down dramatically because people just can't afford the higher interest payment. So, this seems to be, what they're doing and talking about doing in terms of controlling the yield curve seems to be a much bigger deflationary push than what people may currently expect because of the trickle down effects throughout the economy.
Yeah, and I think we both agree that the next period will be more deflationary than inflationary. But the more warped the economy gets, and the more people are concerned about prices, supply lines, deglobalization, there's a lot of different factors out there, the odds of inflation upticking increase.
Yeah.
I'm not saying there's going to be hyperinflation. I'm not even 100% sold there's going to be inflation, inflation above 2 or 3%.
Right.
But the risks of that happening are greater today than they were 3 months ago, 4 months ago.
So back to Daniel's question then is, how does gold play with that environment? So we have no fear in the markets, and we have no inflation currently, but ultimately, how does gold play with that in that type of environment where you have yield curve control?
So to answer the question pretty easily, the way I think about gold is like the dollar, right? What's the price of gold right now, Lance? It's about $1,700, give or take a little.
Yep.
Right? $1,700 per ounce of gold. So instead of thinking it about like a stock or a bond or a price of a car or a house, I think about it as dollars. You're really short dollars. And as the price of gold goes up, it means it costs more dollars to buy that gold. As gold goes down, less dollars. So really what you're doing is you're making a bet on the Fed. Now, day to day, this isn't a bet on the Fed. This is just about speculators and futures and just like any stock or bond. But in the long run, you're making a bet on what the Fed is going to do to the currency. And everything we've seen for the last, 30 years, 40, since 1970, actually, when we went off the gold standard, was they will do whatever they can to manage the economy. And that always means hurting the currency, doing things to make the dollar cheaper.
All right, quick break. We'll come back, wrap up the show with Michael Lebowitz. Don't go away.
You better run, you better do what you can. Don't wanna see no brother be a macho man. You wanna be tough, better do what you can. So beat it, but you wanna be bad. Just beat it. No one wants to beat it.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Baby shark, baby shark, baby shark, baby shark, mommy shark, mommy shark, mommy shark.
You're not going to get out of this show without Mike getting his personal theme song here for the Nationals. Speaking of that, Major League Baseball talking about a 60-game season this year. And I feel sorry for the guys that I really kind of feel sorry for, the guys in the AAA league, because they're gonna get paid like $14,000 for the season on a pro-rated basis. They really kind of get hit pretty hard. But that's one of the kind of the kind of concerns here, though. Again, pulling people back into stadiums. We're talking about now we're so late in the season to start baseball. If you try to run 60, 70, 80 games, whatever it is, you're going to run pretty much into the late fall season, which is potentially where our biggest risk of a resurgence of the virus is, right?
Right. And actually, Dr. Fauci, this was interesting because he's been pretty optimistic, right, about a lot of things, especially going forward. And he warned baseball that they got to be careful about how far their season extends. Typically, it goes to the very end of October, even early November. And it sounds like he's warning them that there could be a resurgence, even though he's been a little less public about that, in other venues. So that's interesting. The other big question is, how are these teams, right? Baseball, hockey, and basketball are all talking about starting in July at some point,
right?
And football's right around the corner, right? What are these teams? Basketball is the most interesting because there's 5 players, right?
Right.
And the good teams have 1 or 2 of the best players in the league, and that's what makes them good teams.
Right.
What's going to happen if one of these teams has 4 or 5 players that have the virus? They can't play them.
Right.
Right. They're going to put them in quarantine. So, it's just will sports, at least in this next upcoming season, football too, right? What happens if Deshaun Watson gets COVID, he's out for 3 weeks, or Patrick Mahomes, like your key players, your running backs, your receivers, your key defensive men, right? What's going to happen if 10 people on the team get COVID? Are they just not going to play their best players? I mean, it's
you go hire Keanu Reeves, you do the replacements with Gene Hackman. I mean, everybody knows how this works.
right. I mean, I'm just as a big sports fan, I'm worried that sports, at least in this next partial season, whatever you want to call it, are not going to be the same, and it's going to be tilted towards volatility, right? We always talk about volatility in the markets. Yeah. We're going to see volatility in sports, right? If you take the top three, if you take Mahomes and a couple of his good receivers off the Chiefs, they're not very good anymore.
Right.
Now, the upside is, as a Redskins fan who was the second worst team in the league last year, there's all upside. It's all upside.
You've got a shot this year.
If we can just avoid the COVID, we can win.
Well, there's always upside when you think about things this way. But no, I do think it's interesting because, there's a kind of an interesting thing, shift that's occurring right now mentally. And this kind of goes with the markets as well, is that, hey, we're coming out of the virus and there's this belief that there's not going to be a second wave. You're getting more and more people going, the second wave is. I saw an article out the other day from Ron Paul, talking about the second wave's a hoax. I think that's a dangerous assessment, to make, and whether or not you believe that the lockdowns were necessary or not, that's a personal call. But to think that if you start reopening the economy, you're not going to have a resurgence of the virus, I think is a bit short-sighted. Now,
and it's also right back to what you said. The personal aspect is really, I don't think they're going to lock down things again. They may, but I don't think so. But people will lock themselves down. Mm-hmm. And we see it everywhere, right? Right. Even in places that are open, restaurants are not back to 100% or even anywhere close. And that's not just a recession. People don't want to be inside. Yeah. They don't want to fly. They don't want to travel. There's a lot of things people don't want to do because they don't want to get the disease.
Well, no, it's very true. I mean, just a good example. I was supposed to have a lunch meeting today with some new clients we've got coming on. We're working with a family office, and we're going to have a lunch meeting today. And got a call last night. I said, hey, can we just do it all by video, because we're uncomfortable going to a restaurant and we're still concerned about the virus, and we're just not ready to do that. And I'm like, sure, yeah, whatever. But that's the mentality of it, right? And we're still at that point that a lot of people are past it, and they're like, I just want to get out back and do things. But there's still a lot of people, particularly people that have pre-existing conditions, or they've got a wife or a spouse, with a pre-existing condition, or, some type of potential illness or age even. People are still very, I think, psychologically still very aware of that. And the reason we bring that up is that, this is stuff that you and I have been writing about, is that the potential to have this V-shaped recovery that the markets are betting on right now is really a stretch of probably what's going to happen. I mean, we're seeing some initial bounces, like we just saw good retail sales numbers earlier this week. But that's that initial pop off very depressed levels. Now the problem is going to become sustainability. I'm writing a piece for Friday, and prior to the financial crisis, retail sales grew at about a 5% annual growth rate. Okay, and that goes back to 1950, something like that. And so you've had this 5% growth rate. Now, after the financial crisis, we were growing at 3%. So you had this step down in terms of retail sales, in terms of its growth rate. And so coming out of this, even if we assume that, the retail sales numbers, earlier this week were magical, and now everybody's back to work, and now we go back to that 3% growth trend, we will be at a lower rate of retail sales than we were post the financial crisis. And it's the same thing we're seeing with economic data. We keep there's this stair step down after each one of these crises. The more QE that we do, the more interventions that we do to try to stabilize things, the more we're creating slower rates of economic growth, a bigger wealth gap, and making it more problematic to grow the economy long term because of the reduction of wealth.
Right. Let's just talk about people in forbearance, right? There's over 4 million families in mortgage forbearance right now, meaning they're not making their mortgage payments, right? Well, what did they do with that money? They spent it on other stuff, presumably, right? They helped retail sales. Yeah. Bills, whatever. No doubt it made retail sales better than it would have been, right? Right. There was some consumption with that money. So now those people they owe more money because they're going to have to pay interest on that because it's, sort of like a late fee. And their future ability to spend is lessened. And that was in exchange for the current little boost to retail sales. And that ripples through the whole economy, that the more debt there is, the less they can spend. Right. So yes, we're getting a boost. The numbers are better than they would have been, but what's the cost? And the cost, as you said, is lower retail sales, lower consumption, lower economic growth.
Yeah. It's interesting, forbearance, it's always, people tend to try to jump on things that they go, oh, look, I don't have to make my mortgage payment. I can do this forbearance, thing, and I don't have to make my mortgage payment. They still charge you interest on the payment, but it shows up on your credit like a bankruptcy. And what a lot of people don't know is they go, oh, I'm just going to skip a payment and it's just a late thing, right? No, when you forbear a mortgage, it's just like a bankruptcy on your credit report. And there's going to be a lot of people that come out of this with a damaged credit report going, I had no idea that's what that was, because people aren't told that, right? I mean, it's just the way, but that's the way it's going to get reported, and that's going to hurt people's ability. And if you take a look at lending standards, this is also in the report I'm doing for Friday. Lending standards to individuals has tightened sharply. If you want to get a mortgage, you want to get a refinance, you better have 700 plus credit. You better have a decent down payment, and that's going to make it very challenging for individuals to obtain more credit, to expand their spending and do this, particularly if you're out of work or on government assistance, whatever it is. That's going to make it very challenging to expand consumption if you can't get access to more credit.
And more so that a lot of companies are getting hit, right? Their earnings have been down sharply. They're going to look for ways to cut costs. So a lot of consumers are going to be weary, right? They're going to be very concerned about their job, about their hours, about the rate of pay. And that will just inhibit people to stop spending on the margin or, to varying degrees for each person. So, we're still in a recession, right? The numbers are looking okay because the government is just dumping money on the problem and it's being spent. But that goes away. And we're going to actually start seeing that go away as early as later this month, and especially in July and August. If the government can get another bill out there and write everyone $1,200 checks and keep unemployment support going and all that stuff, then maybe the economy will do okay. But this is just the government feeding the economy, not the economy standing up on of legs. And those are two different things. And as you look forward, that's what you have to think about. Right.
And again, just kind of, with, as we kind of look forward here over the next couple of months, we're into summer. This is typically a slower time of the year anyway. And now we've got some, other issues that are starting to crop up, we saw the impeachment process earlier this year, and now with Bolton's book out, now there's going to be a potential resurgence of that. We're going to try to retry that case again here before the election. Now, and again, a lot of this, there's hope for, rekindling the extra $600 a month for unemployment benefits, more checks to households. But all that news has now been very quiet. And those expanded benefits are running out next month. And we haven't heard anything coming out of the Congress or Senate about expanding those benefits, extending them, adding more to them. We've not heard any of that right now. And we're getting pretty close to the election. So you've got to think that, the Democrats are going to start trying to say, hey, we don't want to help Trump too much here, because we need the advantage going into the election.
No, and I've also heard a bunch of Republicans that are worried about the deficit. That may also squash things. So I think it's both sides. Both sides of the House and the Senate may not be up for a big sweeping infrastructure bill or spending bill or unemployment bill or whatever it may be, especially this close to an election.
Well, the infrastructure bill was killed by the Senate, which is more Republican than Democrat, which was surprised me as well. I mean, it made no traction in the Senate at all at this point.
Right.
So, but again, the point is that may start to kind of weigh on outlooks if there's no more support coming from Washington over the next couple of months, and all of a sudden individuals don't have that extra money. Could impact the economy short term. Mike, thank you so much. Michael Lebowitz, CFA. Of course, get by our website. His article about yield curve control is on the website now, realinvestmentadvice.com. Make sure and read it. It's a really, really good piece. It really explains kind of what's going on. And then, like I said, tomorrow we're going to have a report out on retail sales, what it means for the economy, all on the website, realinvestmentadvice.com. Make sure you're registered for our newsletter. We send out every weekend. good review of the markets and what to do with your money. RealInvestmentAdvice.com. Have a great day. And of course, we'll see you tomorrow in the next edition of The Real Investment Show. I'm your host, Lance Roberts. Stick around, though, because Chris Salcedo is coming right up.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.